Some people have asked whether the SEC is really trying to just kill SPACs. That this is their attempt to kill it all. And maybe there's some of that, although I
Welcome to the SPAC Alpha web series. My name is Dan Dombrowski. And with the SEC SPAC proposals at the forefront of everybody's minds, I thought it'd be a great idea to have a legal expert join me and weigh in. So I asked Ramey Layne, a capital markets and M&A attorney at Vinson and Elkins, to break down the different elements of these proposals to get a better understanding of what the actual implications are. Now, I'll leave it to Ramey to better introduce himself, but I will say that this is a comprehensive discussion that focuses on the critical elements of these proposed changes, so I do hope that you enjoy.
Well, Vinny's an international law firm. My personal practice is focused on capital markets and mergers and acquisitions. We have, I think, 20 plus partners in our group who have experience in SPAC transactions across both IPOs, de-SPACs, representing underwriters, representing investors or existing owners of target companies, and then representing public companies after they have gone public via a de-SPAC transaction. We've been doing this since about 2016, so not quite the OGs of the SPAC legal practice like some others, but have been doing it to the extent that it's now effectively 80+% of my practice over the last 2 years.
So I appreciate you walking me through that. If we could take from a very high level, what exactly are the proposed changes, and why are they happening, and why are they happening right now?
Sure. So there's a lot of proposed changes. I mean, the SEC is proposing, I think, easily a dozen new rules or regulations. The SEC has been focused on SPACs for probably the last year and a half. If you go back to when they first started putting out guidance, basically saying SPACs either weren't consistently providing material information for investors, or they weren't providing, across the board, some material information. So Chair Gensler has been focused on SPACs and has been talking about them for a long time, talking about the potential for investors to not have adequate information. And most importantly, he's talking about the lack of gatekeepers. There aren't institutions who are making sure that only companies that effectively are ready to go public are going public via this route. So it's been on their agenda for a while. And they, after a fairly long period of talking about SPACs, have finally decided to adopt rules.
Sure. And just from the very top, what do these rules look like?
So there's a bunch of them. Some are beneficial or just neutral. Like, for example, there's some weird inconsistencies between what kind of financials would be required by a target company in a de-SPAC as compared to what would be required by a target company if it went just public via regular IPO. So they're aligning some of that, which is good. It's beneficial. There's some that sort of could be beneficial, including the Safe Harbor from 40 Act, investment company status, which basically says that SPACs are mutual funds and should be regulated like mutual funds. The Safe Harbor would roll that back so that they're not regulated like that if they qualified. A bunch are neutral. I mean, the SEC has been commenting on SPAC registration statements both for IPOs and de-SPACs, pretty much for every transaction for decades now. And so there's sort of a standard practice for disclosure in IPOs and de-SPACs, and a bunch of the rules just codify that. They're just adopting a whole new section that says disclose X, and it doesn't really change anything because everybody was already disclosing that. There's a handful of them that are considerably more substantive, that are just getting a lot of chatter. And that's basically the SEC's come out and effectively is criticizing the use of projections by SPACs in de-SPAC transactions, and it's going to impose a whole bunch of new rules on that. They're going to expand underwriter liability. So institutions that acted as underwriter for the SPAC IPO may have liability in connection with the de-SPAC for disclosures. That's the gatekeeper idea that Gensler was getting after. And then there's some others where the SEC is proposing incremental disclosure about fairness of a de-SPAC transaction and requiring some disclosure of reports and opinions and stuff like that.
And I do want to dive into the more granular aspects of each of those. But right now, could we lay out what does the actual timeline look like for everything? Right now, we're in the comment period. Just can you lay out how long is everything going to take to be codified?
So you're right. We're 3/4 of the way through a 60-day comment period currently, where Anybody who wants to comment on the rules can submit comments via the SEC's website or via email to the secretary. And you're starting to see those comments already. I think there'll be a whole bunch more. A lot of institutions, law firms, and lobbying organizations are probably going to submit comments, but they usually wait until kind of the very end to submit those. So most of what you see right now are, law professors lobbying in there. I did this research on SPACs. Here it is, in case it's helpful. And then a whole bunch of retail investors who are basically complaining that the new rules are going to kill SPACs and they won't have an opportunity to invest, or that all the rules are silly because all the information is already disclosed. So comments come in. The SEC then is required to respond to those comments if they adopt new rules. So they'll process a mountain of paperwork that comes in, consider whether to make adjustments to the rules, and then they may adopt new rules. They don't have to. Occasionally the SEC proposes rules, gets a bunch of comments, and then does nothing with it. I don't think that's the case here. I think there's been enough chatter about SPACs that the commission's going to do something here. They could extend the date for comments. They do that with some frequency. Or they could just let it expire here at the end of the month, take the comments, and then they're going to take their time to figure out what to do with it. For example, they could, if they get a whole bunch of comments that make them change the way they're thinking about something, and it would be, they'd like to adopt a new rule, but it'd be substantively different than what they've already proposed. They may re-propose a rule so that they could get more comments on a different format. They could adopt some of these as is and re-propose or revise others. It's sort of pretty much the SEC there's a whole bunch of different ways they can go with these rules. If I'm a betting man, I would say that a lot of these rules are going to be adopted as is. Or with moderate revisions. I just think there's right now the composition of the commission is Gensler and two other Democrat nominees, and then one Republican, and they just seem really inclined to adopt a whole bunch of new rules right now. And so I'd be surprised if they don't adopt these. It may take them a couple months, but probably sometime Q3, Q4 of this year, I would expect these rules to become final.
And it does sound like there is precedent to be taking these comments into consideration. And I recognize that you said that a lot of these comments may come in the last day or so, but is there any that you've seen come in that just make a lot of sense that could be really heavily weighted?
Not yet. I haven't seen any that, I don't think any of the law firms the last time I checked have made any comments. SIFMA, which is basically it's an association of investment banks. They haven't commented yet. So I would expect that we're probably a good week away. I guess I'm not sure when this is going to post, but it'll probably be the 25th or so before people really start posting the substantive comments.
And is there anybody that you're really particularly going to be paying attention to?
I'm going to be fascinated by whether any of the investment banks or any of their sort of trade associations put in comments. There is a SPAC association which might put in comments. I would expect they probably will. That'll be interesting. And then I'm as sort of a nerd, I'll be interested in looking at those put in by other law firms to see if they have different views on whether something works the way I think it does or not. Just for consensus, but so far I haven't really been focused on the way other law firms have been talking about the rules. I'm trying to keep my thoughts sort of my own and not allow for any inadvertent, not necessarily plagiarism, but cross-contamination of my personal views.
Yeah, I don't think you're alone in that in any sense, based on the news feed. Now, I do want to get into the actual substance of what this proposal will actually mean. So can we take a look first at the safe harbor and projections aspect of this?
Sure. So this is the one that probably is getting a lot of chatter. I think the SEC, so the SEC has said that there is regulatory arbitrage in de-SPACs, that you don't see projections in IPOs and you do in de-SPACs. And they took some quotes from Chamath about how de-SPACs were better than IPOs because you can use projections, and somehow interpreted or divined that what people were saying is because there's a safe harbor. So the Private Securities Litigation Reform Act was adopted in the 90s.
It basically says if an existing public company makes a forward-looking statement, a projection of future, some future action or result that happens, and provides sufficient cautionary language. So I say, I think I'm going to make $1 bajillion in 2025, but here are all the reasons why I might not. If you say that, there's a safe harbor and you can't be sued for that if it proves to be wrong. That's available in de-SPAC transactions. Arguably, the SEC likes to say, well, it's unclear whether the safe harbor is available, but most practitioners just sort of agree that you have the SPAC, it's an existing public company, makes a forward-looking statement, the PSLRA is available. The Private Securities Litigation Reform Act safe harbor is expressly not available in an IPO. So basically, the SEC has said there's this regulatory arbitrage. People that, companies that would go public via an IPO are instead going public via de-SPAC because they want to avail themselves of this safe harbor. So they want to shut that loophole as they see it. I think they're wrong. I think if you look back at what Chamath was saying, he was saying it's a public company merger. In public company mergers, you use projections, you across the board do. And the reason you don't have projections in IPOs isn't that the PSLRA isn't available. It's that underwriters don't want to be associated with a transaction that involves particularly risky disclosure, and they view projections as risky because they may prove wrong. You do see projections in some IPOs, notwithstanding the absence of the PSLRA safe harbor. So IPOs by master limited partnerships, yield cos, and REITs have almost sort of as a matter of practice included 1 to sometimes 2 years of projections, but they're very heavily scrutinized by the underwriters. So the SEC is basically saying, we're going to eliminate this loophole. We're going to take away the PSLRA safe harbor. So in connection with the de-SPAC, there's no longer a safe harbor. And then they've added some guidance about what the SEC's policy is on projections. It's a whole bunch of additional disclosure about whether projections are based on historical results or not. There's some sort of non-GAAP explanations they want to add, a few things like that, that are kind of at the margin additions. So lots of chatter about whether eliminating the safe harbor would eliminate the use of projections in de-SPACs. So far, it hasn't. I mean, if you look at the deals that have gotten announced so far in May, I think based on where I looked, through the 17th, there were 10 deals that had announced. 9 had investor decks. 8 of those 9 had projections. And some of them were just for 2022. I think Grindr only used 2022 estimates. Although if you look at their S4, they actually have like 3 or 4 years of projections in there. So it's interesting. They're not using the projections to the same extent as they used to. It used to be before the SEC came out with this proposal, you saw projections in pretty much every de-SPAC, right? I mean, the back of the investor presentation had 3 or 4 pages. Here's our financial projection through 2020, whatever. And then they would have sort of a benchmarking page where they benchmarked a representative year against comparable companies.
I think it's important to differentiate on the use of projections here. So we've got for valuation purposes, and then we've got for marketing. So who does this actually benefit?
So, I mean, it probably benefits plaintiffs' attorneys, honestly. I mean, it sort of, an interesting thing, the SEC had an acting director named Coates, who came out with probably a 10-page article on liability in connection with de-SPAC transactions and spent half of it talking about the PSLRA. And maybe this is really an IPO and thus the safe harbor doesn't apply. And you shouldn't be thinking that there's less liability, all kinds of stuff like that. But practitioners, I mean, I had never had a conversation with a target company or a SPAC saying a SPAC is better than an IPO because there's this safe harbor. It just wasn't discussed. The only people that discussed it were the SEC and then litigators who thought, if I'm defending a suit against a SPAC because the projections proved wrong, I have this handy little safe harbor. So it changes the litigation posture slightly. But I think what a lot of the chatter about the elimination of the safe harbor misses is there's a common law doctrine called bespeaks caution, which the safe harbor was based on, which basically says, if you provide a forward-looking statement and you explain how it could be wrong, there's no way for a plaintiff to have relied upon it. You can't say, if I say I'm going to make $1 bajillion in 2025 and I tell you all the reasons that it could be wrong, And it proves to be wrong because one of those reasons, it's very difficult for a plaintiff to say, I relied on that statement and therefore you had a material misstatement or omission in the disclosure. So I think you're going to continue to see the use of projections. A lot of these companies, it would be almost impossible to market a pipe without some projections. You know, you need a model of some sort. And then to your earlier point, the board of the SPAC has a fiduciary duty to basically enter into the best deal it possibly can. And it's almost impossible for a board to determine to approve a merger with a company without looking at projections. I mean, that's why you see them in every public company merger, right? I mean, it would probably be, it would be a breach of fiduciary duties of boards, arguably, if they just said, oh, well, we're just going to merge with this company, but we didn't really do any diligence about their model or their projections, et cetera. And once the board considers something important to its decision, it's required disclosure in the proxy. It's required to say, here are the projections we received, and here's what we thought about them effectively. And the SEC has actually provided that comment before. We did a deal, oh, I don't know, it's probably 2018, where our initial filing of the proxy didn't include the projections that the board used, and the SEC said, put them in there. So we did. So it's a little odd that the SEC is now saying, well, this is just an IPO and you really shouldn't be using projections where you don't have a reasonable basis for them, when in a merger, which is fundamentally what this is, they insist on their disclosure. It kind of puts the board a little bit between a rock and a hard place of, you got to do your diligence, you got to look at everything you possibly can and disclose the material facts. And yet the SEC is taking away the safe harbor, arguing that somehow that the projections disclosures might be misleading to investors.
That starts getting into the liability aspect of this, and I want to make sure that we cover the treatment of SPACs as investment vehicles. Now, could you give your thoughts on this classification?
Sure. So the Investment Company Act of 1940 is designed to regulate mutual funds effectively. And there's been some suits and allegations by a couple of professors that SPACs are really mutual funds. The test is if more than 40% of a public company's assets are in securities, and I'll just elide over what that is a little bit, then it's an investment company unless there's an exemption, or if the primary business of the company is investing in securities. So these lawsuits and these professors say, well, while the SPAC's a SPAC, all of its assets are in this trust account. All those trust account assets are invested in US government securities or mutual funds investing in US government securities, and those are securities. So therefore, it must be a mutual fund. I personally disagree with that. I think the primary business of the SPAC is not investing in US government securities. It's hunting for a deal to invest the cash in. And that's reflected in the fact that if you lined up 100 SPACs and said, okay, SPAC officers, how much time do you spend managing the trust account, actively focusing on how to make the best return from the investments in portfolio of securities? It's going to be zero. It's going to be like, I spend 2 minutes at the very front, I talk to the guy that's going to manage it, and then it just sort of runs itself. But notwithstanding that, there is a straight-faced argument that all these SPACs are invested in securities, therefore they're mutual funds. What the SEC has proposed is a safe harbor if the SPAC signs up 18 months of its IPO and closes it within 24. And if it doesn't do that, it liquidates and gives all the cash back to investors. And then there's a whole bunch of other little sort of technical things that the SEC is proposing. But if you meet that, importantly, that 18 and 24 month timeline, then there's a safe harbor and you don't have to register as a mutual fund. And registering as a mutual fund would be prohibitive. Every SPAC would liquidate rather than register as an investment company. It just doesn't, practically speaking, doesn't work. So that's what the SEC is proposing. I mean, sort of the knee-jerk reaction to it is, well, this is great, right? There were these lawsuits alleging that Pershing Square and other SPACs were unregistered mutual funds. If you have these suits out here, it might have a chilling effect on a company wanting to do a deal with you, right? You don't want to merge with a company that's an unregistered investment company. That would be bad. So a safe harbor is good, but the problem is some of the conditions that the SEC has proposed, sort of importantly, the timelines have a taint that is applied effectively to every SPAC that's getting really close to or already over those timelines. Because the SEC said in the proposing release, not complying with these 18 and 24 month timelines raises serious doubt about whether the company is really an unregistered investment company. So the hint is, if you're a SPAC and you haven't done a deal and you're at month 19, a lot of target companies may say, I don't know if I really want to do a deal with that SPAC. I'd rather go deal with one of the other 600 SPACs that's hunting that hasn't yet sort of crossed that the point where the SEC says maybe you're an investment company. Interestingly, the SEC looked at, they have a whole bunch of data in there of surveys that they've conducted or that they've reviewed. I think by their own math, only, I think it was 57% of the deals from like 2016 to 2020, only 57% would have met those two requirements, implying that for 43% of the deals that got done, there was actually this 40 Act problem that no one raised, and that, ultimately I don't think actually damaged investors at all. So I don't know. My personal view on that one is a safe harbor is welcome, but you shouldn't have almost half of the deals in a survey sample disqualified and not meeting the requirements. So I'm hopeful that the SEC sort of comes up with a safe harbor that's a little bit more practical for the hundreds of SPACs that have already gotten deals done and the 600 more that are still hunting.
No, but could that actually be intentional to create a hard deadline?
It's possible. I think they were kind of thinking, most SPACs don't have more than a 24-month outside date anyway. I mean, it sort of ignores the fact that a bunch of them have extended. But 18 months and 24, I think their thinking is probably a reasonable timeline for a company to pull a deal together and get it done.
Yeah, so great transition to start speaking about the liability aspect of this. Could we walk through what these proposals look like and how that branches out from liability?
Okay, so there's a couple of things that the SEC is doing on liability. There's probably three things. Two of them are sort of technical, and then there's one that's just a sort of massive sea change in the way liability works under the Securities Act. So the first two technical ones first. So first, the SEC is saying a de-SPAC transaction is deemed to be an offering of securities to the SPAC's shareholders, even though in form, the SPAC shareholders may just stay shareholders of the same company that changes its name, right? I mean, that's sort of the traditional de-SPAC is effectively the SPAC merges with a target company or acquires it, changes its name to, pick whatever the new name is, and then charges on with its life. There's a redemption offer to the SPAC shareholders, but there's not an offer to sell securities to them. So first, the SEC is saying that every de-SPAC transaction is a deemed sale to the SPAC shareholders. That's going to mean that instead of just using a proxy where the SPAC survives, there's going to be a registration statement. It'll be a Form S4 or a Form F4. There's some slight liability differences between liability for material misstatements or omissions in a proxy statement as compared to a registration statement. I don't think fundamentally those matter. I mean, when we're advising a target company or a SPAC, and there's a reason to do the transaction in a way where the target acquires the SPAC, you have that's absolutely a sale to the security holders of the SPAC. You have an S4 and F4. We'll do that without thinking a second about hypothetical differences between liability between that and a proxy. So if there's a tax reason or you want the resulting company to be domiciled in the Netherlands and be a foreign private issuer, you'll go like that to a registration statement. So that's one thing. The next thing they're doing is the SEC is going to require the target company and a majority of its directors and executive officers to sign that registration statement. So right now, if you have a SPAC acquire a target company, the SPAC is the one doing the speaking, right? It's its proxy statement or its registration statement, and only its directors and officers have direct statutory liability for signing the registration statement. Now, so the SEC is going to say, okay, now target company, you have to sign it, which means everybody who signs the registration statement now has liability under the 33 Act for material misstatements or omissions, subject to a due diligence defense. So directors and officers can establish a due diligence defense if they do all the work they could and they couldn't reasonably know of the material misstatement or omission. So that one's, I've had a couple of conversations where people think that might be a big deal. I don't think it is. I mean, just to put it this way, I mean, one thing to step back on is the SEC, a lot of what the SEC is doing is putting up this sort of dichotomy of, does the SPAC transaction have the same liability, same disclosure, same everything else of an IPO? If you buy that those are the choices. You either go public via an IPO or you go public via a de-SPAC, then a target company and its directors and officers, if they were going public via an IPO, they'd have liability for all this stuff too. Now, they might not use projections, so that might be something that they wouldn't have liability on, but they'd have the same registration statement liability as they would in an IPO or a de-SPAC. Moreover, most target companies and their executive officers acknowledge that in a de-SPAC transaction, most of the liability, if there is liability for material misstatements or omissions, is going to be post-closing. And post-closing, it's all one big happy family. So the fact that the SPAC is the one that had the liability when the SPAC now owns 100% of the target company means that if you're really thinking about, well, we need to minimize liability, we need to minimize exposure for our investment in this company, the fact that you didn't sign a registration statement or it wasn't your proxy statement doesn't really change the resulting liability of the combined company. So that's one that I think it is technically different. It's interesting just from sort of a theoretical standpoint that, should this really be like an IPO? But it's not substantively going to change the way target companies or their directors and officers really act, with one exception, which is D&O insurance policies for private companies often have an exclusion for securities liabilities. So your existing private company D&O policy may not cover this expanded liability before you're a public company. So you might see a need to sort of negotiate for incremental coverage so that those directors and officers aren't sort of out in the cold on their potential liability. Now, the most important change that the SEC is doing is their sort of gatekeeper role here. So the SEC observed that in de-SPAC transactions there is no sort of underwriter. There is no institution who is liable for the proxy statement or the registration statement. And the SEC purports to just be interpreting the definition of underwriter. Underwriter, in the traditional sense, an underwriter buys from a company and then resells, right? They're a conduit for the securities, and they basically market the securities. But the definition in the Securities Act is any person or entity who participates in a distribution. Participates is the key word there. SEC, looking at SPACs, basically say, okay, well, if you're an institution that took the SPAC public and then you participate in the de-SPAC, that's sufficient participation in order for you to be a statutory underwriter. There's a couple logical sort of jumps there. First, the SEC says that the de-SPAC is a distribution, which maybe it is, maybe it isn't, it may depend on the form. But then the second step is that pretty much any involvement with the de-SPAC, including the receipt of deferred comp, which is sort of ubiquitous across SPAC IPO structures, is that the underwriting syndicate gets a deferred underwriting discount at de-SPAC, that's sufficient participation to make you an underwriter under the 33 Act. Like I said, the SEC is purporting to just interpret the term underwriter. So basically, the SEC has effectively come out with guidance that says on all of the de-SPACs that have ever happened, investment banks that participate are statutory underwriters, and then they're adding a new rule that will expressly state that. So that one's interesting. That's the most impactful piece of all this from my point of view. We're already seeing changes in practice by the investment banks. So at IPO, you're likely to see more investment banks that negotiate for a right to due diligence in connection with a de-SPAC, because underwriters have what's known as a due diligence defense. If they do diligence that a reasonable person would, and they don't find out about the material misstatement or omission, I'm paraphrasing, then if they can establish that at trial, then they shouldn't have liability. So a lot of them have started negotiating for that for the back end. We've seen one IPO where the underwriters just got paid the 2% upfront. There was no 3.5% back end, which is definitely in response to what the SEC said about receipt of deferred comp as participation. And then in connection with de-SPACs, you're seeing a bunch of banks step back. I mean, Goldman has come out publicly, B of A have come out publicly and basically said, we're not going to participate in these until the rules are final. And I think implicit in that is, and we might not participate after that either, depending on what the ultimate rules say. Beyond that, you're seeing the investment banks that are participating in the de-SPAC do a lot more diligence. So they're having their lawyers scrub not just the pipe deck, which is what historically they've done, but also scrub the proxy statement. And they're asking for the types of deliverables they would get in an IPO or another registered offering. They're asking for legal opinions from all the law firms. They're asking for what's known as a 10b5 negative assurance, which basically the law firms say, I've done diligence and I don't have any reason to believe that the information is there's a material misstatement or omission. And they're asking for comfort letters from auditors as well. So that's been the big change. I think in terms of practice by the SPACs and the target companies, the facts that underwriters are going to be more conservative about projections probably will drive SPACs to use projections less, be more conservative, and have more disclosure about assumptions and considerations underlying the projections. So it's not the absence of the PSLRA safe harbor. It's the underwriters are worried they're going to have liability is what's really driving the change on projections.
And with all that, it sounds like the liability is highly dependent on the transaction structure itself. Now, you had mentioned that firms like Goldman Sachs, Bank of America, Citigroup had mentioned all of these pulling out. What kind of void does that create in the market?
So, well, just for clarity, I don't think Citi has announced they're pulling out. I think Citi and CS have announced that they're going to take it more seriously. Effectively, they have a committee involved that's going to screen whether they should participate or not. So they're not backing out fully like Goldman is. But I think there could be opportunities for banks that are more willing to take the liability here. The boutique banks, the middle market banks, and then the others that have just decided that sort of the SPAC practice is important enough to them that they're gonna effectively adapt to it and move on. But we're certainly seeing, and it may just be a function that we're sort of in this limbo area between the proposing releases and the final, where everybody's sort of figuring out what everything is. It is making it a little disruptive. On one de-SPAC that we're working on, we had 2/3 of the pipe syndicate, the investment banks on the pipe decide to withdraw. So makes it a little difficult to pull off a pipe, and has some interesting, questions of, can we proceed? Do we need to add another bank? Who would we add? And as all this is evolving, do we have to worry that if we add a bank that wasn't involved in our IPO, that in the next week or two, they're going to come out as a matter of policy and back out too? So certainly uncertainty around de-SPAC transactions right now, and whether and to what extent banks are going to change their practice.
So even without any changes going into effect, we're already seeing real world consequences of certainly all participants adjusting accordingly. But who are these changes actually going to be applying to? Is it those that are marketing, that have announced? Is there any backwards looking on this?
So it's a good question. So the SEC could adopt an effective date for their new rules. They could say for all de-SPACs announced after January 1st, 2023, just by way of example, then any bank who had participated in the IPO is an underwriter. I'm not sure whether they're going to do that, in part because they do purport to just be, yes, they're adopting a new rule to make it clear, but effectively they're saying all these former deals, the SPACs were underwriters too. So it's a little unclear. I think the SEC is wrong on that point. I think the case law about what it means to be participating in a distribution isn't just everybody tangentially related to a distribution, which is sort of what the SEC is saying here. Now, their rule would only apply to banks that acted as IPO underwriters. So you have to act as an IPO underwriter at the SPAC IPO, and then also have some participation at the de-SPAC. In the proposing release, the SEC says, we're not addressing potential underwriter liability for other participants, but other investment banks, pipe investors, and others may have statutory liability as well. So they've sort of done a shot across the bow that anybody acting as a pipe placement agent, for example, or a capital markets advisor, or on the M&A advisory piece could be an underwriter. So it'll be interesting to see what the SEC does with it. That's where I'm really curious if the investment banks come out and comment on this, or if any of their trade groups do, because that's the one that's sort of most important to them.
And I guess taking a step back from this whole thing, you had mentioned what the safe harbor is actually missing, but in addition to that, are there any other misses with these proposals, or unintended consequences that could play out that nobody's really thinking about?
So not particularly. I mean, the underwriter liability is the big one, I think. Some people have asked whether the SEC is really trying to just kill SPACs. You know, that this is their attempt to kill it all. And maybe there's some of that, although I take the SEC at their word that they're really just trying to align it with IPO treatment. Although that said, some companies can't go public via IPO, right? You can't find an underwriter to take a pre-revenue, high-growth company public necessarily. So some of these companies may if SPACs aren't available, it's not, well, let's just go public regular way. It's let's stay private for another 3 years, raise VC money or private equity money, and then go public eventually. So I think this is probably just one more headwind for SPACs right now. You know, they were already facing a lot of headwinds by virtue of high redemptions, difficulty raising pipes, et cetera. And this is sort of just one more straw on the camel's back. I don't know if that answers the question.
Yeah. Another aspect that I was thinking about, I believe we discussed it briefly, but could you, I guess, elaborate on your view on proxy reform?
Okay, sure. Okay, so one of the things the SEC asked about, they're not proposing a rule on this, but they acknowledge it and talk about it a little bit, is what's known as an empty voting problem. Empty voting is where you're the owner of record on the record date, you sell your shares of stock, the vote date comes along, you can now vote, even though you don't own your shares. It's called an empty vote. So you have no economic interest in the transaction anymore, but you have a vote. And it's effectively just a function of the way our proxy rules work, which is you have to select a record date, figure out who all the holders were on the record date, mail them a big packet of information, and wait at least 10 days. And potentially up to 60 days between that record date and the vote. So all the trading between the record date and the actual vote is effectively results in empty voting. And some institutions have policies that they won't vote if they don't own the shares, you know, a lot of that kind of stuff, which historically at times presented some real problems for SPACs. I mean, there was a wave of, there was probably, I don't know, 4 months or so where there was massive retail interest in SPACs. There's a lot of trading between the record date and the closing date. And the vote date, and retail investors just wouldn't show up and vote, or you had institutions who would take money off the table. So we had a lot of times where we just couldn't get to a quorum because people wouldn't show up. They either had the shares and didn't know how to vote, or they had sold them after the record date and had a policy against empty voting. So the SEC has noted that in most of these SPAC transactions, holders are allowed to redeem regardless of whether they vote for or against. The commentary is actually that it says you can vote against the deal and still redeem, and that has somehow some sort of moral hazard. But technically, most SPACs go beyond that. They don't say you can vote no and redeem. They say, we don't care how you vote. You don't even have to vote, and you get a redemption right. Whereas the stock exchange rules only require that you give a redemption right for people who vote against the deal. I think I may have had that a little backward. The concern is that you vote yes for the deal, but you redeem. So which I think is actually the economically logical thing for investors to do if they don't like the deal. They'd rather have their cash back on redemption than vote down a transaction and be stuck invested in the SPAC still. So the SEC's noted that, and there's a few law professors who have written about it and alleged that it's a problem somehow. So the SEC has asked, should we fix that? Should we, through our control, not control, but through our rulemaking function over the national securities exchanges, require the NYSE, NASDAQ, and Amex to provide that you can only give redemption rights to people who vote against the transaction. The problem with that is the same empty vote. You'd have an empty redemption decision. Every trade after the record date, if you bought after the record date, you can't vote yes or no, right? You don't have a vote. So therefore, if the SEC imposed this requirement that you have to vote no in order to redeem, it would mean that everybody who trades after the record date effectively is trading without a redemption right, which would be a huge problem. There have been a handful of SPACs that actually had that provision in their charter document. You have to vote yes or no. We don't care which way you vote, but you have to affirmatively vote in order to have redemption rights, which causes this, this sort of empty redemption right problem. So that's the SEC's asked whether they should address that. Our commentary is going to be no. The vote is meaningless, and so you shouldn't elevate its importance. When every shareholder has a redemption right, you're not worried about whether the majority of shareholders approves a deal, because you can't force the investor that dislikes the deal to stay invested. So that one's there. I think one thing the SEC is doing, so a lot of what the SEC says they're doing is trying to align liability and disclosure between a de-SPAC transaction and an IPO. And if it's really just an IPO, if you say, okay, all of you investors, you have the right for $10 to have one share in this surviving company, well, you don't have a vote equivalent in an IPO, right? It's not like everybody that you offered securities to, you need a majority of them to invest in order to close the deal. It would be nonsensical. So I think there's a bunch of them where the SEC isn't taking its theory that this is really just an IPO far enough. So it's not aligning sufficiently between de-SPAC transactions and IPOs. One of the things that they've asked about is whether they should also address all their other shell company regulations. So in 2004, the SEC adopted a whole bunch of rules applicable to any shell company, which includes SPACs. And it has all of these provisions like SPACs can't use S8 to register employee compensation plans. Investors in former SPACs can't rely on 144 to have a safe harbor for when they want to sell their securities like they could for an IPO. There's a whole bunch of them. Most of those were motivated by pump and dump schemes. So pre-2005, SPACs weren't listed on National Securities Exchange. They were over the counter, and they could sign up a deal, close it, and announce the deal without a shareholder vote. So what you had was you had these SPACs acquire target companies, and then you had a pump and dump scheme before the public company had to make meaningful disclosure about the business that it just bought. So that was why the SEC adopted a bunch of these rules. All those rules are sort of misplaced when it comes to SPACs today, because at least the ones listed on national securities exchanges, you have to go through a full-blown proxy or registration process replete with SEC comments before you can get to a vote. You have to have that vote before you get to a closing. So it's really hard to do a pump and dump scheme when you're subject to SEC review and comment. So I think the SEC needs to take this is really just an IPO theory a little further and get rid of all those old shell company regs, at least as applicable to SPACs that are going to have to go through a registration statement or a proxy process. And then some of what they're doing is requiring additional disclosure about conflicts of interest, about how the SPAC negotiated and structured the de-SPAC, et cetera, is inconsistent with IPO disclosure. You don't have a section in the IPO about a background of negotiations with the underwriters. So the SEC could go further. I doubt they're going to go all the way on a bunch of those. I think they think the conflicts inherent in the SPAC structure are such that it justifies incremental disclosure as compared to an IPO. But that is one theme that they just sort of, they're saying that they're trying to make this work like an IPO, but they're really not going all the way.
I appreciate you expanding on that. I'm going to back up for 1 second because I want to make sure that I cover another aspect for liability. What options do each participant have to hedge their exposure from proposed liability changes?
Okay, so the liability as applicable to SPAC really isn't changing much. The SEC is proposing to add some incremental disclosure by the SPAC and its directors and officers. One of those incremental disclosures is a requirement to disclose whether the board thinks the transaction is fair to the public investors in the SPAC. So that'd be new, and then arguably, you'd have liability for that. There has been some discussion about whether this is going to result in a wave of fairness opinions being given to SPAC boards. So that would be one way. You'd say, how did you determine it was fair? Well, I got this opinion from Oppenheimer or Guggenheim or whomever. I haven't seen that yet, but that could be one possibility.
But fundamentally, the directors and officers of the SPAC already had this. There's not incremental liability there. The target company, I think, they may be a little bit more conservative about the disclosure they use in the pipe, trying to minimize risk by being sort of less blustery in their disclosure, and then probably would be well advised to at least dust off their D&O policy to make sure that they're covered for Securities Act liability before the closing. The real fundamental changes are going to be the underwriters. So underwriters in an IPO do a whole bunch of diligence. They have their law firms, basically dig through all the material contracts, have a whole bunch of calls with the operating companies, lawyers and advisors and auditors to sort of make sure that they understand the business and that they can make sure that all the risks are adequately disclosed. So they're going to start doing that. Those that participate in the DSPAC are going to start doing full IPO style due diligence to try and establish a due diligence defense. I think collectively you'll see a lot of them sort of try and push back on the use of projections, because you can't really diligence projections other than to sort of understand the model and make sure that assumptions and considerations are disclosed. So you'll see banks that are participating due diligence try and cut back on disclosures that they think are particularly risky. And then you'll see some that just back out altogether. Now, under the SEC's the proposing release, even getting the back end fee on the IPO is sufficient participation to have liability. So if you have underwriters who don't want to have that potential liability, they really should waive their back end fee. So that's one thing that we're starting to see. It raises some interesting issues, because sort of saying, well, if you don't want to participate, you just don't participate and waive your back end fee. But I guess there's a question of when do you make that decision? So you may end up with some bizarre scenarios where you have deals with a pipe placement agent or investment advisor, M&A advisor or capital markets advisor, who, as the deal progresses, as they do more diligence, as they look at the proxy statement, decide, whoa, wait a minute, I really went out, but they've already rung the bell. So what we haven't seen yet, and the SEC doesn't really address, is, okay, well, what are the consequences if a bank backs out? Do you have to tell the public investors, oh, by the way, Goldman was participating in this de-SPAC transaction at IPO, and then halfway through the process, Goldman withdrew? Goldman's maybe not the best example there, because they're not withdrawing from any particular de-SPAC because of the particular target company. They're just withdrawing across the board. But if you have a bank that participates in some deals and doesn't participate in others, what do you have to tell your investors about why they withdrew? And does that have some sort of negative taint on the deal?
There's so many moving parts to this.
It's big. I mean, I'm telling you, that one, the underwriter liability is a pretty massive change, and it could be challenged. That's, I think, one thing on this, and the sort of the process here is, the rules that are adopted by the SEC can be challenged as going beyond the SEC's authority. In order to do that, the sort of allegation that they go beyond the authority, or the deficiencies in the rule or in the process, have to be alleged in the comment letter process. So you may see people trying to sort of lay a groundwork for a future challenge in the comments that get made and get proposed. But that one's one that I think would be ripe for challenge, is the SEC's expansion of underwriter liability here. They could, there are others that I think arguably go beyond the statute, like saying that every de-SPAC is a deemed sale to the SPAC shareholders, or there's a deemed distribution there. But given that I don't think those really change things too much, I don't know whether those will be challenged. So the underwriter liability is the big one. I mean, you're talking about like $6.8 billion of deferred underwriter comp in the deals that are just hunting right now. So there's a lot of cash there that could motivate the banks to try and get that rule revised or eliminated. The SEC could go a different route there, which is actually, I think one of our comments is likely going to be
the SEC, because the SEC has rulemaking authority over the NYSE, NASDAQ, and Amex, they basically set the rules that the exchanges have to abide by in connection with listing companies, including IPOs, de-SPACs, and registered directs. So the SEC could mandate that there has to be a role for an independent investment bank in connection with every de-SPAC, and that investment bank has underwriter liability there. That would be so much cleaner, right? If you'd say you have to have a valuation agent or something like that on a de-SPAC, then it would provide certainty as to the bank for the banks as to which ones specifically have liability. They can go into it with their sort of eyes wide open, establish a due diligence defense, and charge an appropriate fee. It's kind of what I would hope the SEC would do, rather than take this really broad brush of everybody participating is an underwriter.
Taking these changes into account, looking at the SPAC ecosphere or ecosystem in its entirety, what are your thoughts going forward?
So I think there's going to be massive disruption while these rules are interpreted, or the proposed rules are interpreted. And then once the SEC adopts them, as we sort of shake out what this really means for the various market participants. If they adopted their proposed Investment Company Act safe harbor, you might see a bunch of SPACs that are long in the tooth and past those deadlines liquidate. I think they should probably just switch to cash. They just sell their securities and just sit on cash. But we'll see what the outcome of that is. That's going to be one of our questions: is could you just do that, right? You just switch to cash. But fundamentally, you might see certain institutions just backing out of it entirely, right? Goldman may make its policy of not participating while the rules are pending, may make that permanent, which would be interesting because they're in the top 10 of the league tables on these deals over the last several years. So you could have banks that take that approach. I think you'll have others who say, I'm fine with liability here. Let's just take really sharp pencils to projections and make sure that we understand what they're based on and make sure we have adequate disclosure there. So I don't think it may change who's participating. I don't think it fundamentally changes the appeal of de-SPAC transactions to certain target companies. I think there's going to always be an opportunity there for target companies that aren't quite ready for an IPO, but have an attractive valuation in the public markets as compared to a venture capital round or something like that find this to be compelling. So I'm hopeful that this won't fundamentally change the way SPACs are structured and the way de-SPACs are getting done in the future. Just to use an example, the 40 Act safe harbor could have massive implications for certain existing SPACs. But if every future SPAC had a hard and fast 24-month deadline, would that really dissuade people from taking a SPAC public or doing a deal with it? No, probably not. So even the big changes that are impactful for tons of SPACs today won't really matter for sort of SPAC IPOs in the SPAC market in the future once it sort of works its way through the system.
In this interview, we've gone over what the process looks like for timeline, how long it's going to be, all aspects are going to take to be codified, the substantive aspect of this for safe harbor, investment company treatment, the underwriter liability, and then your thoughts going forward. But even with that, I'm sure we still missed good portions of this. Now, you came up with a write-up, or a pretty comprehensive write-up. It was the SEC proposed SPAC rule changes that I'm going to put in the show notes. But with that, I really appreciate you taking the time to speak with me today.
Thanks, Dan. It was my pleasure.